Before you invest your first dollar, you need to understand one critical truth about money. Investing is not about getting rich quickly, but about building wealth consistently over time. Many beginners rush into investing without knowing where they truly belong. This confusion usually starts with choosing between stocks, ETFs, or crypto. Each option can make money, but each also carries different risks and responsibilities. Your first investment choice should match your knowledge level goals and emotional tolerance. If you ignore this, even the best investment can feel like a mistake. Stocks are often the first thing people think about when investing. When you buy a stock, you own a small piece of a real company. That company produces products, offers services, and generates revenue. Your money grows if the company grows and becomes more valuable. Stocks reward patience, research, and long-term thinking. They also teach you how businesses operate in the real world. This makes stocks a powerful learning tool for new investors. However, stocks are not risk-free, especially in the short term. Prices move daily based on news, earnings, and investor emotions. A single bad decision by a company can impact its stock price. Beginners often panic when they see their stock drop suddenly. This emotional reaction causes many people to sell at a loss. That is why mindset is just as important as strategy. You must be comfortable seeing temporary losses without quitting. Stocks require effort. If you want strong results, you need to research financial statements, company leadership, and industry trends. This may feel overwhelming at first, but it builds valuable skills. The more you learn, the more confident your decisions become. Confidence helps you avoid emotional mistakes during market volatility. Over time, this knowledge compounds, just like your money. One advantage of starting with stocks is control. You decide which companies to invest in and when to buy or sell. This control helps you feel connected to your investments. It also makes investing feel more purposeful and intentional. You are not guessing. You are making informed decisions. This builds discipline, which is essential for long-term success. Still, stocks are not ideal for everyone as a first step. If you lack time or interest in research, stocks may feel stressful. Watching individual companies closely can become exhausting. Some beginners lose motivation because of information overload. This is where understanding alternatives becomes important. Before choosing stocks, ask yourself a simple question. Do you enjoy learning how businesses work and tracking their performance? If your answer is yes, stocks may be a great first investment. If your answer is no, there may be a better option for you. Your first investment should feel manageable, not intimidating. ETFs or exchange-traded funds are one of the easiest ways to begin investing. They are designed to simplify the process while reducing unnecessary risk. Instead of buying one company, an ETF gives you exposure to many companies at once. This instantly spreads your risk across multiple businesses and industries. For beginners, this diversification is extremely valuable. When you invest in an ETF, you are not betting on a single winner. You are investing in a collection of companies grouped together for a purpose. Some ETFs track the entire stock market. Others focused on specific sectors like technology, healthcare, or energy. There are also ETFs for bonds, real estate, and even global markets. This flexibility allows beginners to invest without deep research knowledge. One major advantage of ETFs is simplicity. You do not need to analyze individual balance sheets or earnings calls. The fund automatically adjusts as companies grow or decline. This makes ETFs a low-maintenance investment option. You can focus on consistency rather than constant ETFs are also emotionally easier to handle. Because your money is spread out, price swings feel less extreme. A single company failing will not destroy your entire investment. This reduces panic selling, which is one of the biggest beginner mistakes. Staying invested is easier when volatility feels manageable. Another benefit of ETFs is affordability. Many ETFs have low expense ratios, meaning minimal fees. You keep more of your returns over time. Some brokers even allow fractional ETF purchases. This means you can start investing with very little money. Low barriers make ETFs accessible to almost everyone. ETFs are also highly liquid. You can buy and sell them easily during market hours. This flexibility gives you control without complexity. You are never locked into your investment, yet long-term holding is still the recommended strategy. For beginners, ETFs encourage good habits. They promote long-term thinking instead of short-term trading. They reward patience and consistency rather than timing the market. These habits are critical for financial success. Most wealthy investors rely heavily on ETFs for this reason. However, ETFs are not perfect. They do not offer the thrill of picking individual winners. You will not experience massive gains from a single breakout stock. Returns tend to be steady rather than explosive. For some investors, these can feel boring, but boring is not bad in investing. Boring often means stable, predictable, and sustainable growth. Most people lose money trying to chase excitement. ETFs remove much of that temptation. If you want a hands-off approach, ETFs are ideal. If you have limited time or experience, ETFs make sense. If your goal is long-term wealth, ETFs provide a strong foundation. They are often the safest and smartest first investment. Cryptocurrency attracts beginners faster than any other investment. The promise of fast money and massive gains is extremely tempting. Stories of overnight millionaires dominate social media. This creates fear of missing out for new investors. But crypto is very different from stocks or crypto is not backed by traditional companies or cash flow. Most cryptocurrencies rely on technology, adoption, and speculation. Their value is driven largely by demand and market sentiment. This makes prices extremely volatile. A coin can rise or fall 20% in a single day. For beginners, this volatility can be emotionally overwhelming. Many people panic when prices crash suddenly. Others become greedy when prices rise quickly. These emotional swings often lead to poor decisions. Buying high and selling low is common in crypto. Crypto markets also operate 24 hours a day. There is no closing bell to give your mind a break. Prices move constantly, including nights and weekends. This can lead to obsessive chart watching. For new investors, this behavior can be unhealthy and stressful. Another challenge is lack of regulation. Crypto markets are still evolving and loosely controlled. Scams, hacks, and failed projects are common. Many coins disappear after attracting investors. Beginners often struggle to identify legitimate projects. That does not mean crypto has no value. Blockchain technology is innovative and powerful. Some projects solve real-world problems. Long-term adoption could drive significant growth. But success is far from guaranteed. Crypto requires education. Before investing, you must understand wallets, exchanges, and security practices. Losing access to your wallet can mean losing your funds forever. There is no customer support to recover mistakes. Responsibility falls entirely on the investor. Unlike stocks and ETFs, Crypto offers no historical stability. Traditional markets have decades of data and proven growth. Crypto is still in its early stages. This makes long-term predictions uncertain. Risk management becomes absolutely essential. For beginners, crypto should never be the first or main investment. It works best as a small portion of a diversified portfolio. Most experts recommend limiting crypto exposure to a small percentage. This protects you from devastating losses. Crypto is not investing for the impatient or uninformed. It rewards discipline, patience, and emotional control. Without these traits, losses are likely. If you enjoy technology and can handle extreme volatility, crypto may fit you, but it should come after building a stable foundation. Learning with safer assets first is usually smarter. Choosing where to invest first becomes easier when you compare all options clearly. Stocks, ETFs, and crypto each serve different purposes in a portfolio. The best choice depends on your risk tolerance, time, commitment, and goals. There is no universal answer that fits everyone. Stocks offer ownership in individual companies. They provide strong long-term growth potential, but they require research, patience, and emotional discipline. A single mistake can significantly impact your results. Stocks reward those who enjoy learning and analyses. ETFs focused on diversification and simplicity. They reduce risk by spreading investments across many assets. ETFs require less effort and ongoing management. They're ideal for beginners who want steady growth. Consistency matters more than perfect timing with ETFs. It offers the highest potential reward and highest risk. Price swings can be extreme and unpredictable. Crypto demands strong emotional control and technical knowledge. It is not beginner-friendly without proper education. Let's talk about risk levels. Stocks carry moderate risk depending on the company. ETFs generally carry lower risk due to diversification. Crypto carries extremely high risk and volatility. Beginners should always prioritize risk management. Now consider time commitment. Stocks require regular monitoring and learning. ETFs can be mostly passive, and hence crypto often demands constant attention. Your lifestyle should influence your investment choice. Emotions also play a major role. Stocks test patience during market downturns. ETFs help reduce stress by smoothing volatility. Crypto amplifies fear and greed dramatically. Emotional control determines long-term success. Another factor is knowledge required. Stocks demand understanding of businesses and financial metrics. ETFs require basic market knowledge. Crypto requires technical security and market awareness. More complexity increases the chance of mistakes. Accessibility matters too. ETFs and stocks are available through most brokerages. Crypto requires exchanges and digital wallets. Each platform comes with different risks. For most beginners, ETFs provide the safest entry point. They allow you to learn while growing your money steadily. Stocks can be added later as confidence increases. Crypto should be approached carefully and gradually. Smart investors build foundations before taking risks. Rushing into complex investments often leads to losses. Your first investment should build confidence, not anxiety. The smartest way to invest is not about excitement, but about structure. Successful investors follow a clear order when building wealth. They focus on stability first, growth second, and speculation last. This approach protects beginners from unnecessary losses. The first step for most people should be ETFs provide instant diversification and lower risk. They allow you to participate in market growth safe. You learn how markets move without intense pressure. This builds confidence and discipline over time. Starting with ETFs also helps you develop consistency. Regular investing teaches patience and long-term thinking. You stop chasing short-term profits. Instead, you focus on steady progress. This mindset separates successful investors from gamblers. Once you understand the market, stocks come next. Individual stocks allow you to apply what you've learned. You can research companies and make informed decisions. Stocks give you higher growth potential than but now you are prepared to handle volatility. Stocks also help sharpen your financial skills. You'll learn how businesses grow, fail, and adapt. This knowledge increases your overall investment intelligence. Mistakes become lessons instead of disasters. Experience reduces fear and emotional reactions. Crypto should always come last. Only invest in crypto once you have a solid foundation. These point you understand risk and portfolio balance. Crypto becomes a calculated risk, not a blind gamble. Losses won't destroy your financial future. Smart investors limit crypto exposure. They never bet money they can't afford to lose. Crypto should enhance a portfolio, not dominate it. Discipline matters more than hype. Another key factor is personal goals. Short-term goals require lower risk. Long-term goals allow more flexibility. Your timeline should guide your strategy. Never invest emotionally or impulsively. Your income stability also matters. Emergency savings should come before investing. Debt should be managed before high-risk assets. Investing works best from a position of strength. There is no rush to invest aggressively. Time is your greatest advantage. Compounding rewards. Patience more than speed. Starting safely often leads to better results. In the end, the best first investment is the one you understand. Knowledge reduces fear and increases confidence. Confidence leads to consistency. Consistency builds wealth. Start simple. Grow smart. Take risks only when you're ready.